You know that feeling when you see some company news, maybe about their earnings, or you hear terms like audit or assurance thrown around?
Yeah, and you kind of think, okay, I get the gist, but what's really going on behind that headline?
Exactly. It can feel like there's just too much noise, right?
Definitely. Information overload is real.
Well, that's what we try to cut through here on the deep dive. We aim to pull out the essential insights for you.
Hmm.
And today we're doing just that with the world of auditing and assurance services. We've got a mix of sources, some core concepts, some more practical examples.
Yeah, the goal is really to give you, the listener, a solid foundation so you'll understand what assurance actually is, why auditors matter, the whole deal with ethics and independence, which is huge, and how auditing itself is changing.
We want to go beyond just definitions, find those aha moments, maybe even a few surprising bits.
Right. More than just scratching the surface.
Okay, let's dive in. First things first. What are assurance services and how are they different from, other stuff accountants might do?
Okay, so at its core, assurance is about confidence. Simple as that.
Confidence in what?
Confidence in information. So say an investor is looking at a company's financial report. They need to trust those numbers, right?
Makes sense.
Assurance services, like an audit, are designed to give users that confidence. It's like getting a seal of approval, or maybe a second opinion that makes the information more credible.
A second opinion on the numbers.
Okay.
I think I've even seen stuff about assurance on non-financial reports, too.
Oh, absolutely. That's a really growing area. Groups like the Global Reporting Initiative are actually pushing for external assurance on things like sustainability reports.
Sustainability? Really?
Yeah. Look at UPS, for example. They get assurance reports done by big accounting firms on their greenhouse gas emissions data. It adds that layer of credibility. And honestly, many people think this is going to become way more common for all sorts of non-financial info.
Huh, interesting. So assurance isn't just stuck on the financial statements anymore. Now, you mentioned audits provide assurance. Are there different kinds or levels of assurance?
Yes, definitely. It's not all the same level of certainty. A full audit of historical financial statements. That's generally seen as the highest level you can get.
Highest level. Okay.
And an interesting point here. Management is the one preparing those statements. They're basically asserting, yep, these numbers are fair according to the rules. The auditor then comes in, does a lot of work, gathers a ton of evidence to provide that high level of assurance that management's claims hold water.
Okay, high assurance for an audit. What about a review? I hear that term sometimes.
Right, a review. That offers a lower level of assurance, sometimes called limited or moderate assurance.
Lower. Why would you want lower assurance?
Well, it often comes down to cost and need. Reviews are common for smaller, non-public companies. A full audit is expensive, and maybe the users of their financials, like a bank providing a small loan, don't need that super high level of assurance.
Oh, okay.
Management still makes the same claims about the numbers, but the accountant does less work in a review compared to an audit. So less assurance, but also less cost. It depends on the information risk. How likely is it the info is wrong, and how much assurance do the users really need?
Got it. So audits give high assurance, reviews give moderate, and then you mentioned some services provide no assurance.
Exactly. Accountants do lots of things that aren't about giving an opinion, like preparing financial statements for a client based on their data that's called a compilation. No assurance there,
They're just putting the numbers together.
pretty much. Or they might do very specific tasks that the client and maybe a bank agree on, like checking specific calculations. That's an agreed-upon procedures engagement. Again, no assurance. The accountant just reports what they found based on the procedures they performed.
Okay, so assurance comes in different strengths, and some services are just about doing tasks, not verifying. Now, who oversees all this? The public accounting industry sounds like it needs some structure.
Oh, it's definitely structured. Globally, you've got the massive Big Four firms everyone knows. Here in Canada, we also have several large national network firms, maybe a bit smaller, but still significant.
Right, and beyond the firms themselves, who are the rule makers and watchdogs?
Okay, several key players. At the provincial level, you have the CPA organizations. These are fundamental because individual CPAs are members provincially.
So they handle the basics.
Yeah, the crucial stuff. Licensing CPAs, making sure they do ongoing education, inspecting firms to check their quality, handling complaints, and even disciplining members or firms if needed. They're the ground level regulators.
Okay. Provincial bodies are key. What about nationally?
Well, there's CPA Canada, which plays a national role, though our sources don't go deep into specifics.
Hmm.
Then, very importantly, there's the Auditing and Assurance Standards Board, the AASB.
ASSB, what do they do?
They set the standards. Specifically, Generally Accepted Auditing Standards, or GAAP, for financial statement audits in Canada. These aren't just rules. They're principles and requirements auditors have to follow. The AASB also sets standards for other assurance work and those non-assurance services like reviews and compilations.
So they write the playbook.
Essentially, yes.
Hmm.
And a key thing they're doing is adopting the international standards on auditing ISAs as Canadian Auditing Standards, or CAs, trying to get everyone on the same page globally.
That makes sense. So there's an international body too?
Yep, the International Audit Assurance Standards Board, the IAASB, they work on improving those ISAs and quality control standards worldwide, aiming for high quality everywhere.
Okay. And any other Canadian players?
One more really important one, the Canadian Public Accountability Board, CPAB.
CPAB sounds official.
They're an independent oversight body focused specifically on the audits of publicly listed companies in Canada. They inspect the audit firms that handle these public companies regularly. Think of them as a watchdog for investors in the public markets.
Okay, wow. Provincial bodies, AASB setting standards, IAASB internationally, and CPAB watching the public company audits. Lots of oversight.
It's a layered system, definitely.
Let's zoom back into the audit itself. What are the core principles? What's the auditor really trying to achieve?
Well, the main standard, CAS 200, lays out the auditor's overall objectives. Basically, three key things. One, express an opinion on the financial statements in a written report, always written.
Okay.
Two, state whether those statements are presented fairly according to the relevant accounting rules like IFRS or ASPE.
Makes sense.
And three, and this is critical, the auditor only takes on the job if management agrees to cooperate, provide evidence, and acknowledges their own responsibility for the financial statements.
So management owns the numbers, the auditor audits them, but management has to play ball.
Exactly. It's a prerequisite.
Yeah.
And then the auditor has personal responsibilities they bring to every single audit.
Like what?
Things like professional competence,
Yeah.
having the right skills and
Yeah.
knowledge and due professional care, doing the job diligently and thoroughly.
Standard professional stuff.
Right. Plus, adhering to all the ethical rules and maintaining independence, which we absolutely need to talk more about. And then two really big ones, professional skepticism and professional judgment.
Okay, professional skepticism sounds important. Does it just mean being suspicious?
It's more nuanced than just suspicion. It's having a questioning mind and critically assessing the evidence you gather.
Questioning mind and critical assessment.
Yeah, it's that trust but verify mindset. You can't just accept what management tells you without question. You need to probe, ask why, look for inconsistencies, and really evaluate the evidence. Is it reliable? Does it actually support the claim?
So if management says sales are down because of the economy,
A skeptical auditor asks, okay, which economic factors specifically? Do industry trends back that up? Can I see other evidence that confirms this? They dig deeper. It's a crucial safeguard.
I see. And the other one was professional judgment. How does that fit in?
Professional judgment is about using your training, knowledge, and experience all within the context of the auditing, accounting, and ethical standards to make informed decisions during the audit.
So it's not just following a checklist.
Definitely not. It's analytical, systematic, objective. It involves understanding the why behind the numbers, considering different possibilities, and making reasoned choices based on the specific facts and circumstances. It's a thinking process, not just a mechanical one.
Okay, so auditors need the skills, the ethics, the questioning mind, and the good judgment. How do they actually do the audit then? What's the process for forming that opinion?
A huge part of it is identifying and assessing the risks of material misstatement.
Material misstatement, meaning big enough errors to matter.
Exactly. Errors or omissions that could actually influence the decisions of someone reading those financial statements. To find those potential risks, the auditor needs to really understand the client's business, what they do, their industry, their pressures, their challenges.
Why is understanding the business so key?
Because risks aren't the same for every company. The big risks for a software company are totally different from the risks for a mining company or, say, a bank. Understanding the context helps the auditor focus their attention on the areas where misstatements are most likely to occur.
Like knowing where the weak spots might be.
Precisely. Once they identify those risks, they design their audit procedures to gather evidence specifically addressing those risks. And they need sufficient and appropriate evidence, enough evidence, and the right kind of evidence reliable and relevant.
Okay. And you mentioned skepticism is extra important for fraud.
Yes, definitely. The risk of not catching a material misstatement due to fraud is actually higher than the risk of missing one due to error,
Why is that?
because fraud is intentional. It often involves sophisticated schemes, collusion between people, or management deliberately overriding controls that are supposed to prevent problems. It's designed to be hidden, making it much harder to detect than an honest mistake.
Makes sense. Deception is harder to uncover. Now, earlier you mentioned audit quality. That sounds like a buzzword, but what does it actually mean in practice?
It's definitely more than a buzzword. It's fundamental. Audit quality means performing an audit effectively, following all the professional standards and rules so that the resulting opinion is reliable and users can trust the financial reports.
And why is everyone, like regulators and investors, so focused on it?
Because trust is everything. If the public loses confidence in audited financial statements, it undermines the entire financial system. That trust is the bedrock. So enhancing audit quality is a constant global priority.
Okay, so how do the accounting firms themselves try to ensure they deliver quality audits consistently?
That's where their internal quality control systems come in. Quality control is basically the whole set of policies and procedures a firm puts in place to make sure they and their people meet their professional responsibilities.
So it's their internal rulebook for doing good work.
Exactly. It covers everything from the firm's overall structure and ethical requirements to how specific audits should be planned, performed, and reviewed. The auditing standards actually require firms to have these systems.
Does it guarantee perfection?
No, not an absolute guarantee. It provides reasonable assurance, not certainty, that standards are being followed. But a strong system is crucial.
So what makes up a strong quality control system? What are the pieces?
Several key elements. First, the firm's leadership and overall culture have to emphasize quality. Then you need robust ethical requirements, including processes to ensure independence.
We talked about independence, yeah.
Right. Another is client acceptance and continuance. Firms need solid procedures to vet potential clients, check their integrity, and to periodically reevaluate if they should keep working with existing clients.
So they might actually fire a client.
Absolutely. If there are serious concerns about management's integrity or independence issues arise or major disagreements on accounting, they might walk away.
Wow. Okay, what else?
Human resources is huge. Hiring competent people, providing training, assigning appropriate staff to engagements, evaluating performance, and having clear criteria for promotion, especially to partner, emphasizing things like integrity and judgment.
Makes sense. The people doing the work are key.
Totally. Then there's engagement performance itself, having policies for how audits should be conducted, supervised, and reviewed consistently. This includes needing consultation on tricky issues, maybe with industry experts or the firm's own technical specialists.
So built-in checks and balances and places to get expert advice.
Exactly. And finally, monitoring. The firm needs to monitor its own quality control system to see if it's designed properly and working effectively. Are the policies actually being followed? It's a continuous cycle of improvement.
It sounds pretty comprehensive.
It needs to be. We even saw reference in the materials to a case, Auditing in Action 2-3, where poor quality control led to ethical problems and, well, bad audits. It's a reminder that these systems aren't just bureaucratic hoops. They have real consequences when they fail.
A cautionary tale. Okay, let's circle back to ethics, especially independence. You said it's the cornerstone.
Absolutely non-negotiable. The CPA Code of Professional Conduct is the guide here. It lays out the fundamental principles and specific rules.
And you mentioned two sides to independence, mind and appearance.
Correct. Independence of mind is your actual state of mind being objective, impartial, not letting anything compromise your judgment. Independence in appearance is about how things look to others. Would a reasonable, informed person think your objectivity might be compromised, even if you feel unbiased?
So you have to be objective and you have to look objective.
Precisely. Both are essential for maintaining public trust. Think about it. If an auditor owns a lot of stock in the company they're auditing, even if they swear they can be objective, wouldn't you have some doubts?
Yeah, definitely. That appearance matters. So what specific things are auditors banned from doing to protect this independence?
Well, there are strict rules, especially for assurance clients, like audits. You can't be a director or officer of the client company. You can't perform management functions. Management has to manage.
Auditors audit, managers manage.
Right. The audit team also can't make management decisions, like approving the client's journal entries. Management has to own their accounting records. And there are limits on things like gifts or hospitality. You can't accept anything more than token gifts.
So, clear boundaries to avoid conflicts or the look of conflicts. How do firms track all this?
They have systems. It involves identifying potential threats to independence, like financial interests, business relationships, family ties, assessing how significant those threats are, and then seeing if safeguards can reduce the threat to an acceptable level.
Safeguards. Like what?
Things like having policies and procedures within the firm, getting a second partner review on the audit, or sometimes safeguards within the client itself, like having a strong audit committee.
Ah, the audit committee. How do they help independence?
They're huge. The audit committee is part of the client's board of directors, made up of independent members. They oversee the external auditors, hire them, approve their fees, and review their work. They provide a buffer between the auditors and management, giving auditors a direct line to raise concerns without fear of management pressure.
So they're like an independent watchdog inside the company looking out for the shareholders.
That's a good way to think about it. A strong, active audit committee is a major plus for auditor independence.
And if someone does break the ethics rules, what happens?
Enforcement happens at the provincial CPA level. They investigate complaints and can impose penalties ranging from, extra training or a reprimand to hefty fines, suspension, or even kicking someone out of the profession.
Serious consequences.
Very serious. And don't forget litigation risk. Our sources mentioned the massive settlements some firms have faced, like EY. The big firms apparently set aside a pretty significant chunk of their revenue, maybe 10–20%, just to cover potential legal costs from audit lawsuits.
Wow, 10–20%. That's incredible. It really drives home how high the stakes are for getting it right.
It absolutely does. Quality and ethics aren't optional extras.
Okay, let's revisit professional skepticism and judgment. We know what they are, but how do auditors apply them day to day? Give me a practical feel.
Okay, skepticism in action. Imagine management gives you a complex spreadsheet explaining why a certain reserve is adequate. A skeptical auditor doesn't just accept the spreadsheet. They ask, where do these inputs come from? Are the assumptions reasonable? What if we change this assumption? Did anyone else review this? They look for corroborating evidence outside of that spreadsheet. They challenge the assumptions.
So actively questioning, not just receiving
Yeah.
information.
Exactly. It's that trust but verify dialed up. And judgment comes in constantly, like deciding how much evidence is enough for a particular account, or evaluating if an accounting estimate made by management seems reasonable given the circumstances. There's rarely a single right answer. It requires weighing the facts, applying the standards, and making a reasoned conclusion.
And you mentioned that auditors don't actually fix errors they find.
Right, that AJ and Fran dialogue in the source material was a good illustration. Auditors identify potential misstatements, quantify them as possible, and communicate them to management and the audit committee. It's then management's responsibility to decide whether to correct the financial statements. The auditor's job is to report on whether the final statements are fairly presented, including any uncorrected misstatements they found.
That's a critical distinction. So applying judgment, what's the thought process?
It starts with gathering all the facts, not just the numbers, but understanding the context, talking to people beyond the accounting department. Then critically analyzing that information, looking for inconsistencies or anything that doesn't add up that disconfirming evidence. Considering different perspectives, thinking why, and always framing it within the accounting and auditing standards, often bouncing ideas off colleagues or specialists.
A very analytical, multifaceted approach. Now, another piece you mentioned is understanding the client's business and their internal controls. Why is that so vital?
It's fundamental to the risk assessment process. You can't identify where things might go wrong if you don't understand how the business actually works, how it makes money, how it spends money, how its operations flow.
Like mapping out the processes.
Exactly. Thinking about those business cycles, revenue and collection, purchasing and payment, inventory, payroll, they're all linked. A weakness in how they handle purchases could affect inventory valuation later on. Understanding these flows helps pinpoint potential risks.
Makes sense. And internal controls fit in here how?
Internal controls are the policies and procedures the company puts in place to try and ensure things run properly reliable financial reporting, efficient operations, following laws. Think of them as the company's own checks and balances.
Okay.
The auditor needs to understand the system of controls for two main reasons. First, to assess the risk that a material misstatement could slip through the cracks because of weak controls. This is control risk. Second, if controls seem strong and are working, the auditor might be able to rely on them and potentially reduce the amount of direct testing they need to do on account balances.
So strong controls can mean a slightly less intensive audit in some areas.
Potentially, yes. But the auditor first has to test those controls to make sure they are actually effective.
What are some key types of internal controls we should know about?
Well, you can think about them as direct versus indirect. Direct controls target specific risks, like matching invoices to shipping documents. Indirect controls are broader, like the company's overall ethical tone, or IT general controls.
IT controls. Those must be huge now.
Absolutely critical. Things like access controls who can get into the system and change data, backup and recovery procedures, controls over network security. In today's world, IT controls are inseparable from financial controls from most companies.
And you can also think about preventive versus detective controls.
Right. Preventive controls aim to stop errors or fraud before they happen, like requiring approvals for large payments. Detective controls aim to find errors or fraud after they've happened, like reconciling the bank account monthly to spot discrepancies. You need a mix of both.
Can you give some classic examples of good internal control principles?
Sure. Segregation of duties is a big one. Don't let one person handle too much of a transaction. The person who approves purchases shouldn't also be the one paying the bills.
Prevents them paying fake bills, right?
Exactly. Proper authorization is another, making sure transactions are approved at the right level. Adequate documentation, having a clear paper trail or electronic trail for everything. Independent checks, having someone else review work or reconcile accounts, like that car selling analogy in the source, documenting each step creates accountability.
Got it. Segregation, authorization, documentation, independent checks. Basic but crucial.
Very crucial. And, technology itself is even becoming a control. Think about smart contracts.
Smart contracts. How do they work as controls?
Well, they automatically execute transactions based on pre-agreed rules when certain conditions are met. They're fast, reduce human error, and because they often run on blockchains, they can be very secure and transparent, minimizing chances for fraud or manipulation in some processes.
Fascinating. The tech itself enforces the rules. Okay, let's pull back again. We've got the principles, the risks, the controls. What's the high-level roadmap for an entire audit?
Okay, think of it in phases. Phase 1, client acceptance or continuance. Decide if you want the job.
Right. Checking out the client first.
Phase 2, planning the audit. Develop the overall strategy, understand the business, assess risks preliminarily, figure out materiality.
Setting the stage.
Phase 3, assessing risk in more detail and developing responses. This involves understanding and possibly testing internal controls and planning the detailed substantive tests on account balances.
Figuring out exactly what tests to run.
Phase 4, performing the tests.
Yes.
Actually doing the tests of controls if relying on them, and the substantive procedures gathering that audit evidence.
The field work.
Yep. Phase 5, concluding and reporting. Evaluate all the evidence, aggregate misstatements, perform final reviews, form the opinion, and issue the audit report. And throughout all phases, documentation is key.
A clear progression. And the approach changes based on risk, right?
Absolutely. If the auditor assesses the risk of material misstatement as high, their response needs to be more robust. That might mean assigning more experienced staff, doing more testing, being less predictable in their procedures, and definitely maintaining that professional skepticism. The mix of testing controls versus testing balances directly the substantive versus combined approach flows directly from that risk assessment.
Okay, let's drill down on materiality again. How do auditors actually pick that number?
It's a judgment call, but a structured one. Materiality isn't just about size, it's about impact. Would this error change an investor's decision? Auditors set an overall materiality for the financials as a whole. Then they typically set performance materiality at a lower amount for planning tests on specific accounts, creating a buffer.
The safety margin.
Kinda, yeah. To reduce the risk that undetected errors add up to something material overall. Sometimes they also set specific materiality for sensitive accounts, where even a smaller error might matter, like related party transactions.
And how do they choose the main number? You mentioned benchmarks.
Yes. Common starting points are percentages of things like net income before tax, total revenue, or total assets. Which benchmark makes sense depends on the company and its users. For a stable, profitable company, income might be key. For a startup focused on growth, maybe revenue. For an asset-heavy company, maybe total assets. The auditor picks the benchmark and the percentage based on understanding the users and the business.
So it's tailored. And this ties into the audit risk model. AR equals IRX, CRX, DR. Walk me through those components again.
Okay. IR is audit risk, the risk of getting the opinion wrong. The auditor wants this to be acceptably low.
The risk they want to minimize.
Right. IR is inherent risk. That's the riskiness of an account or assertion before considering any controls. Some things are just naturally riskier, like complex estimates or cash.
The built-in riskiness.
Yep. CR is control risk, the risk that the client's internal controls won't prevent or catch a material misstatement.
The risk the client's system fails.
Exactly. And DR is detection risk. This is the risk that the auditor's own procedures won't detect a material misstatement that exists and wasn't caught by controls.
The risk the auditor misses something.
Correct. The model shows the relationship. Inherent risk and control risk are about the client situation. Detection risk is what the auditor controls through their work. If IR and CR are high, the auditor needs to set DR low, meaning they have to do more or better testing to reduce the risk of missing something.
So more client risk means more auditor work needed to keep overall audit risk low.
That's the logic. More inherent or control risk means less acceptable detection risk, which translates directly into needing more persuasive audit evidence.
Got it. Let's talk about that evidence then. What makes it persuasive?
Two things: relevance and reliability. Relevance means it directly relates to the assertion you're testing. If you're worried about unrecorded sales, completeness, checking recorded invoices isn't relevant. Checking shipping documents is.
Does it actually address the question?
Right. Reliability is about the quality of the evidence. Is it trustworthy? Evidence from independent third parties, like a bank confirmation, is usually more reliable than something generated internally by the client. Original documents are better than copies. Evidence the auditor obtains directly is better than evidence obtained indirectly.
Okay, relevance and reliability. What are the main ways auditors gather this evidence, the procedures?
There's a standard toolkit: inspection, looking at records or assets; observation, watching a process happen; inquiry, asking questions; external confirmation, getting info directly from third parties like banks or customers; recalculation, checking math; reperformance, independently doing a control or procedure the client did; and analytical procedures.
We touched on analytical procedures looking for patterns, right?
Yeah, comparing data over time against budgets, against industry stats, calculating ratios. They're used in planning to spot risks during the audit as substantive evidence and at the end for an overall review. If ratios look weird or trends are unexpected compared to what they understand about the business, it flags an area for more investigation.
And technology is changing this evidence gathering too. ADA.
Hugely. Audit data analytics allows auditors to look at entire populations of data, not just samples. They can run tests on 100% of transactions to look for anomalies, gaps, duplicates, or transactions meeting specific risk criteria. It can be used for control testing, substantive testing, and analytical procedures.
Like finding needles in haystacks much faster.
Exactly. Or confirming that there are no needles. Think about testing for duplicate payments across thousands of transactions. ADA makes that feasible. Or using bots to manage the accounts receivable confirmation process electronically.
Sounds powerful. Any downsides?
The main caution is not to get dazzled by the tech and forget professional skepticism. The tool gives you results, but the auditor still needs to interpret those results critically, understand the limitations, and ask why. It doesn't replace judgment.
Good point. And all this work generates audit documentation.
Yes, the working papers, they're the record of everything. The planning, the procedures performed, the evidence found, the conclusions reached. They show how the auditor got to their opinion.
Why are they so important?
They support the audit opinion, allow for supervision and a review of the work, demonstrate compliance with standards, and help plan future audits. And critically, they belong to the auditor, not the client. Access by others is usually restricted unless legally required.
Okay, the auditor's proof of work. Now, since they often can't test 100%, even with ADA, let's talk sampling. Why sample?
Simply because testing everything is often impossible or just too costly and time-consuming. Sampling lets the auditor draw reasonable conclusions about a whole population by looking closely at just a part of it.
But there's a risk the sample isn't quite right.
Yes, that's sampling risk. The risk that your sample isn't representative and your conclusion is wrong just because of the sample you happen to pick. There's also non-sampling risk making a mistake for other reasons, like using the wrong procedure or misinterpreting results. Auditors try to minimize both.
How do they choose samples? Is it random?
It can be. There's statistical sampling, which uses probability theory to select items and evaluate results, allowing you to mathematically measure sampling risk. And there's non-statistical sampling, which relies more on the auditor's judgment. Within those, you can use probabilistic methods like random selection or non-probabilistic methods based on judgment.
So sometimes math, sometimes judgment.
Often a mix, depending on the situation. The
Jeez.
process is usually plan the sample. What are you testing? How many items? Perform the procedures on the selected items and evaluate the results. What did you find? What does it imply for the whole population?
And what are they looking for? Errors.
Depends on the test. For tests of controls, they're looking for deviations, times the control didn't work. For substantive tests of details, testing balances, they're looking for monetary misstatements.
How do they decide how many items to sample?
Several factors influence sample size for substantive tests. How risky the account is, inherent risk. How much they trust the controls, control risk. How big an error would be material. How much error they expect to find. And how much assurance they're getting from other tests like analytical procedures.
And once they test the sample, how do they apply the findings back to the whole population?
They project the misstatement found in the sample to the population. If they found $1,000 of error in a sample representing 10% of the population, their best estimate of the error in the whole population might be $10,000. Statistical methods give more precise projections and confidence levels. Non-statistical requires more judgment to decide if the projected error is acceptable.
Unless ADA lets them test 100% and avoid sampling altogether.
Exactly. ADA can sometimes eliminate sampling risk for certain tests, which is a huge advantage.
Okay, let's make this more concrete. How would an auditor approach, say, the revenue cycle?
Okay, revenue. Key documents. Customer order, shipping docs, invoice, sales journal. Big risk often is management overstating revenue. So controls tests might involve checking if credit was approved before shipping, or using ADA to check for gaps or duplicates in invoice numbers.
And testing the actual balances.
Substantive tests could include confirming accounts receivable balances directly with customers, performing cutoff tests around year-end to ensure sales are in the right period, and analytical procedures looking at sales trends and margins.
What about the flip side, acquisitions and payments, buying stuff?
Key functions: ordering, receiving, recording the liability, paying. Controls tests might look at purchase order approvals or matching the PO, receiving report, and invoice before payment. Substantive tests could involve examining vendor invoices, searching for unrecorded liabilities, or tracing payments back to supporting documents.
Inventory, that sounds tricky.
It often is. Complex, ties into other cycles. Auditors usually observe the client's physical inventory count existence and condition. They test valuation, is it recorded at the lure of cost or net realizable value. This might involve testing costs back to invoices or analyzing sales data. Drones and ADA are being used here too, observing counts remotely or testing perpetual records.
Okay, payroll.
HR and payroll. Focus on controls over hiring, pay rates, hours, processing payments. Look for segregation of duties. Test authorization of pay rates. Reconcile payroll records. ADA can spot weird patterns like ghost employees or unusual overtime.
And cash, always a target.
It's definitely high risk. Big focus on bank reconciliations. Does the company's cash balance match the bank's? Auditors test these reconciliations and get confirmations directly from banks. They might do detailed tests of cash receipts and disbursements, looking for things like lapping, stealing customer payments, and covering it up with later payments.
It really sounds like they tailor their approach significantly for each area. Okay, we're nearing the end of the audit. What happens in those final stages?
A lot of wrapping up and final evaluations. Auditors look at the presentation and disclosure. Are the financial statements understandable? Is everything classified correctly? Are the footnote disclosures complete and accurate?
Checking the fine print, too.
Absolutely. They evaluate contingencies, potential future losses from lawsuits, warranties, etc. This often involves getting letters from the client's lawyers. They also consider subsequent events, things that happen after the year end but before the audit report is issued that might affect the financials.
Still looking for relevant info right up to the end.
Yes. Then they have to aggregate all the misstatements they found during the audit, actual errors, projected errors from samples, judgment differences, and estimates. They decide if the total is material to the financial statements overall.
What if it is material?
They discuss it with management and the audit committee, pushing for corrections. If material misstatements aren't corrected, it will affect the audit opinion. They also communicate any significant internal control deficiencies they found to management and the audit committee.
And finally, the report itself.
Right. The auditor's report expresses their opinion. Unqualified means clean. Qualified means mostly okay, except for one specific issue. Adverse means the statements are not fairly presented. Disclaimer means they couldn't get enough evidence to form an opinion at all. And reports now often include key audit matters, CAMs, or critical audit matters.
CAMs.
They highlight the areas that were most significant in the audit, required the most difficult or complex auditor judgment, or pose the highest risk. It gives users more insight into the audit process itself.
More transparency. Okay, we focused heavily on audits. Remind me quickly about the other assurance services.
Sure. Review engagements give limited assurance, less work than an audit. Compilation engagements provide no assurance, just assembling the data. Then there are specialized assurance engagements like compliance audits, checking adherence to rules, or direct engagements evaluating something against criteria,
Sure.
and agreed upon procedures where they just perform specific steps and report findings. Again, no assurance.
So a whole range of services depending on the need for confidence. And we kept hearing Hillsberg Hardware Limited. What was that about?
Ah, Hillsberg Hardware. That's the running case study used in the textbook source material. It's a fictional hardware distributor used to provide practical examples for all these concepts, their inventory count, receivable confirmations, how COVID-19 might affect them. It just helps make the theoretical stuff more tangible.
Like a thread connecting the concepts to a real company scenario.
Exactly. It grounds the discussion.
Well, this has been incredibly thorough. We've really gone deep into auditing and assurance. If you had to boil it down, what are the absolute key takeaways for our listeners?
I'd say number one, it's all about trust. Audits and assurance provide credibility that users need. Two, it rests on ethics, independence, and professional skepticism. These aren't optional. Three, it's a rigorous, risk-based process involving deep understanding, careful testing, and professional judgment.
And it's not static, right?
Not at all. It's constantly evolving. Standards change. Technology like ADA is reshaping how audits are done. Auditors need to keep learning and adapting.
So, for our listener, hopefully this deep dive clears up some of the mystery around audits and helps you feel more informed when you encounter these terms.
Yeah, hopefully you now have a better sense of the diligence and judgment involved in providing that assurance.
And maybe a final thought to leave with everyone. In an age of so much information, not just financial, how do we assess credibility? What level of assurance do we need for different kinds of information in our own lives?
That's a great question. Thinking about the source, potential biases, corroborating information. Maybe the principles of skepticism and critical assessment aren't just for auditors.
Something definitely worth pondering. Thank you so much for breaking all of this down for us today. It's been incredibly insightful.
My pleasure. It's complex stuff, but hopefully we made it a bit clearer.
I think you definitely did. And to our listeners, we hope this deep dive was valuable. Let us know if you have questions or ideas for future topics. Until next time, keep diving deeper.